Good morning, everyone. I think the time being just after 10, we will get started. Representative Sanborn is unable to be here today, so I will chair today's committee. And I want to welcome up DRA.
Good morning, Mr. Chair, members of the committee. Thanks for having us back. I believe we left off on page 37 of our presentation. We were just about to start the interest and dividends tax, which Keen is going to cover. Chris does have extra copies if anyone needs them.
Is anybody? Okay. And before we get started on the interest and dividends, does anybody have any questions on the other taxes that we have covered previously? And obviously, if you do, we can get back to that too at the end. But if anyone had anything pressing right now, we could address that. All right. Seeing none, I think we'll
Great.
continue with interest and dividends.
Good morning, Keen Mei Wong, Department of Revenue. So right now we are on page 37 of the slide, and we're starting off with interest and dividends tax. Interest and dividends tax is currently for taxable periods ending on or after December 31, 2023 is at 4% tax rate. Prior to that, it's at a 5% tax rate, and this tax rate is decreasing year over year and will be repealed effective Jan 1 of 2027. All New Hampshire residents, fiduciaries, LLCs, partnerships, and associations with income from interest and dividends will be subject to this tax. Currently, the threshold for the filing as well as income exemption is $2,400 annually and $4,800 for joint filers, and that's an additional exemption for residents aged 65 and older for $1,200 as well as for blind and disabled, similarly $1,200 exemptions. The return is filed on April 15th, well, it's due on April 15th, and similar with the business taxes, there's an extension to file the return if the taxpayer is not able to file that return on time. However, that's just to file the return, it's not to pay the taxes. And similar with the BPT, there's also the requirement to pay estimated taxes. And these estimated taxes are due on April 15th, June 15th, September 15th, and January 15th of the year itself, if the estimated liability is in excess of $500. Moving on to page 38, this is the data that shows the split, the breakdown of the filers. So on the left-hand side, you will have the pie chart to show the large amount of filers, individuals at 97.5%, and 2.5% of them of the filers are partnerships in the states. However, when you look at the interest and dividends tax breakdown, you see that the 39 that from this filing, what exactly is the portion that income portion that makes up these taxable I&D. And you'll see here the large amount of that will be 39% is from dividends, and then 42% is from distribution. You've heard the distinguishing language between, okay, what's a dividend and what's a distribution. Essentially, dividends would be the dividends that you receive normally when you receive a 1099 div, and you report that on your federal return, your 1040 top line there, dividend income. And then distribution would be any kind of distribution of cash or property that's distributed from an S corp, trust and estates, partnerships, and LLCs. Those are distributions, and those are treated as dividends for I&D purposes as well. Moving on to slide 39, this graph shows the 10 years of the interest and dividend components for the 10-year trend. So this is interest and dividend component, not the tax itself. So this is what is the components that makes up the IND income. Once again, you'll see the tax year 21. You'll see the large portion of it is from distributions and dividends, and the smaller portion is from interest income. And then looking down at the chart at the bottom, you'll see actually provide you with the numbers in billions, and that will correlate with the chart above. Moving on to slide 40, it is the IND tax revenue for a 10-year trend, and you see that the IND income is trending upwards, and then in fiscal year 21 there's a slight downward trend, and in fiscal year 22 it's going up as well, and likely the influencing factors on this why fiscal year 22 is moving so just drastically up is likely because of as you see from the previous slide, the large portion of the IND is from distributions and dividends, so likely the payout from dividend and distributions has increased for fiscal year 22, as well as also the increase in the interest rates. Any questions on IND tax?
Representative Doris.
Thank you, Mr. Chair, and thank you for taking my question. Is any of this increase, do you think, related to COVID, or is it just people are taking advantage of their chance to pull money out?
So in terms of the 10-year revenue trend,
Yes, and where it's spiking here at the end a little bit in 22.
in terms of COVID, the COVID impact would impact the IND revenue would likely be from the federal money coming in to businesses, and if the businesses are doing well, and then distribute and provide higher distributions and dividends to their shareholders or members, that you'll see that direct correlation in terms of the increase in the IND revenue.
Okay.
And I think that would be the direct or
Correlation?
indirect,
Yeah.
correlation.
Okay, very good. Thank you.
Yes, Representative Almy.
Thank you. I've got two questions. One of them is related to that. Before COVID, we had the Tax Cuts and Jobs Act, and as I understood it, a large part of the profits from that went to large corporations ended up coming back as profits to us. So we've had this artificial stimulus, and that one, I understand a fair amount of that act is ending soon. Could you
Yes.
tell us about that?
Yes, Representative. So that bit on the TCJA so the TCJA changed the tax structure and required a deemed distribution from foreign dividends coming back into New Hampshire, into the U.S. So essentially that impacts the BPT more, and we're treating that as when on the federal side, when there's a requirement to report it as a deemed distribution, and so there is no sort of incentive for the companies to keep the money offshore, and they therefore actually make an actual distribution back to the U.S. holders. So New Hampshire taxes the dividends, foreign dividends, when they're actually received by the U.S. holders. And so when they actually do that, when they do the actual distribution, that's when we capture that in the BPT return.
Follow up.
Follow up to that one. But also although there were quite a few businesses that weren't paying what they were supposed to be paying, there was on a cut in the amount of tax that the corporations had to pay at the same time. And I think I remember that that was only in order to meet budget criteria, it was only authorized for a certain number of years and that's ending? Or some part of it is ending?
There are provisions within TCJA that kind of phase out or change over time. So that might be what you're referring to, that some of the changes will phase out or change as years go on. To answer your first question, though, I think it's similar to the question about COVID. So to the extent that that money was repatriated back to the United States, and then those corporations decided to make distributions or dividends with some of those profits that came back, then we would see that impact in IND as well. So although, to Keen's point, the foreign dividend paid back to the U.S. entity would be a taxable event for BPT purposes, if that profit then further shifted to shareholders or members based on dividends or distributions, we would see that here. So it's kind of a two-step process almost.
Thank you. And then
Follow up?
this isn't a follow-up, so
Oh.
if someone else has a question. Right.
Okay, we'll go to Representative Ullery and then we'll go around again.
Thank you, Representative Ballman. Thank you, Mr. Chair. So if I understand what you're saying, because the Jobs and Tax Act, whatever the hell it's called, which is supposed to sunset, I think, in 26, because that required a repatriation of offshore account monies back to the United States. The profits of United States businesses, including those businesses located in New Hampshire, increased. Because the profits increased, the distribution of interest and dividends, or dividends in this case, from the profit that the companies saw increased. And because the distribution made people better off, so was the state, because we tax it. And if the Job Act goes away, where do we stand? I think is what Representative Almy is trying to get at, considering that we're also most likely facing a recession within a couple of quarters.
So to answer that question, I don't believe it's 100% correct to say that the Tax Cut and Jobs Act will sunset in 26. There are provisions that are changing. The deemed repatriation was almost like a one-time event where the profits for many years that had been held offshore by U.S. corporations were deemed to be returned to the U.S. And so businesses were able then to actually repatriate those profits and not be taxed a second time because it was taxed under the deemed repatriation. So we kind of saw a one-time impact of that profits that had been held in foreign entities returned to the U.S. The treatment will remain the same going forward. So we kind of saw a blip as many years of profit were deemed to be repatriated, but the treatment of those repatriations is going to remain the same going forward. So it was a one-time event, but it also, the treatment is going to remain the same. So to the extent that businesses continue to repatriate those foreign profits and pay out those profits via distributions or dividends, that would impact our I&D revenue.
Follow up?
Thank you, Mr. Chair. Okay. What does that mean? As far as revenue estimates, 4 years out.
So I think we saw the largest kind of one-time impact when that initial deemed repatriation and actual repatriation occurred. Right now, I don't anticipate, but Keen's about to correct me if I'm wrong, I don't anticipate significant differences in year-over-year interest and dividends revenue as a result of that we would need to account for. We're kind of in a new normal. We've seen the impact, and I don't think that there's any changes that we need to account for in the period that you're going to be estimating revenues.
And I also just want to add that deemed repatriation from the TCJA, that essentially is the mechanism for the federal government to change the taxation for corporations from a worldwide taxation basis to a more of a territorial basis. And to assist in that change, it's required to, I can't remember the specifics on the policy, is that they've changed and therefore requiring the treatment of these offshore funds and having them deemed repatriated back to the US. So that when that occurred, is to facilitate the transition from the worldwide to the territorial system. And that's that one-time event, and we still continue tax on a actual distribution. So whenever the companies, offshore companies, find that okay, they have funds offshore that they want to actually distribute back to the U.S., that would be when we see that our BPT going up. And then if following that thought, if the company would continue on to distribute that funds to the shareholders, that would be an IND implication.
You have a follow-up for Representative Ellery? And then
All right, I'll take that. Okay, so the IND is going away, but the money is still going to be there, which is going to show up on the BPT side.
That's correct.
That all
That's
right?
correct.
So it's not real. It's not really going away.
So I think the concept of it going away, as Keen just kind of mentioned, this deemed repatriation that happened at the beginning of the Tax Cut and Jobs Act for federal purposes generated significant amount of taxable profits federally, right? Because the amounts were deemed to be repatriated. It was many years of profits that had been held offshore. So the federal government was going to tax a large portion of profits that hadn't been taxable previously. That was going to generate a fair amount of one-time taxable income for businesses. So to help balance that out, there were a number of cuts to the federal tax code that occurred at the same time so that businesses did not see this significant spike in their taxable liability, right? So the repatriation was going to increase your taxable liability, but there were other provisions that were going to change or be cut to decrease the taxable liability, hoping to end up somewhere in the middle. And now what's happening is some of those cuts or decreases in businesses' taxable liability are starting to phase out as this deemed repatriation has phased in. So there was the one-time bump of many years of foreign profits that were taxable. Now we're just taxing foreign profits on more of an ongoing basis. And so we've, as Keen mentioned, transitioned to this territorial system where we're kind of trying to get to that middle point. So when we talk about certain things in the Tax Cut and Jobs Act coming to an end, it's that phasing out as we start to reach this new normal going forward. Hopefully that makes sense.
Boy, a flat tax will come in handy.
Representative Ames.
I think the important question for us as we try to do our revenue estimates and look to the future is that what's happening as we come off of that first bump and go forward, and whether it's going forward above where it would have been or not, given the very, there are lots of elements in this. And what I'm wondering is whether any of the national groups, including the government, have been tracking this issue. It's pretty fundamental in terms of what are the profits that are taxable that go into our calculation of profits.
So the thing to remember for New Hampshire purposes with the Tax Cut and Jobs Act, TCJA, and this deemed repatriation is New Hampshire is a static conformity state. So we conform to a specific date of the Internal Revenue Code. Not all states operate that way. Some states are what's called rolling conformity, where the state just adopts the changes to the federal code as they happen. New Hampshire and many other states are static conformity. So we did not conform to the Tax Cut and Jobs Act until after the deemed repatriation had occurred for federal purposes. So what we see now in New Hampshire in terms of repatriation benefit, revenue impact, is when those distributions are actually, or dividends are actually paid back from the foreign entity to the United States. And those are taxable for New Hampshire purposes. Because at the federal level, they have been deemed to be repatriated, there is an incentive for businesses to actually pay that money back because they've already paid tax on it federally. So when they pay it back in the form of a dividend at the federal government, they've already paid tax on it. So that actual payment is tax-free because it was previously taxed. But for New Hampshire purposes, we collect the tax when the actual payment is made. So I think the short answer is there is a federal incentive to pay that dividend back that didn't exist before the Tax Cut and Jobs Act. And that is a taxable event for New Hampshire purposes. So it is likely that TCJA increased the number of dividends that were paid back from foreign entities to the US, therefore increased some portion of our BPT base because of it. And that will remain that way going forward until that provision is removed federally, or we update to a newer version of the code. So I think at this point, given that we've been conformed to TCJA for a number of years, I would say that benefit or that increased revenue that we see because of the fact that these distributions are deemed to be taxable federally and the tax has already been paid, that is in our base today. So when you're looking to, and we'll talk about this in a few slides, when we start the revenue estimating later this week, we're going to look at a base for 23 and then a growth rate for 24 and 25. I would say that benefit from TCJA is in the base of 23. And there is, at this point, no reason that I think we need to make any specific adjustments to account for changes for 24 and 25.
Representative Platt.
Thank you, Mr. Chair. Thank you for taking my question. You referred that we're periodic conformity, static conformity, so we're conforming to 2018. Other states are continuously moving it up to stay with the feds. Do you have positives or negatives of making that move? If we were to develop a instant conformity?
So with a rolling conformity, you don't have the opportunity to review the changes that the federal government has made and how that will impact your state. So the static conformity that we have, we, the DRA, report to this committee and Senate Ways and Means in March of every year about the changes from the code that we're currently tied to the current code. And we kind of inform you about what changes, positive or negative, may exist. And so you're able to make an informed decision. States that do rolling conformity, again, you're kind of at the mercy of the federal government. And if they decide to make a change that could be, potentially detrimental to revenues here in New Hampshire, you don't have the opportunity to review that change. You just have to follow it. I will say states that are rolling conformity typically have a broader tax base than New Hampshire does. So there's a sales tax and an income tax as well. So they could maybe take their risk profile might be different because their tax base is broader.
Representative Roachford and then
Thank
Representative
you,
Elroy.
Mr. Chair. Thank you for my question, and just want to make sure I'm understanding this correctly. So I think sometimes we look at our BPT revenues and equate that to temperature, the health of our businesses in the state of New Hampshire. But if I'm hearing you right, the BPT boost that we're seeing may be secondary to some changes that the federal government has made. So it's maybe not an accurate indicator of our business climate in New Hampshire.
Correct. And so when we went through the BPT slides at the last presentation, you may remember that the majority of our business profits tax revenue comes from very large multinational corporations. And so it is probably a more indicative barometer of their health. And our smaller, New Hampshire only businesses pay a very small portion of our business profits tax. So the tax as a whole can kind of indicate general health of the economy, but I would caution about making any specific assumptions about New Hampshire-based businesses from the business profits tax revenue, because it is primarily coming from large multinational corporations.
Can I follow up?
Follow up?
Yeah. So thank you. So you're saying it's a health of the company, but it may just be indicative, not necessarily of the health of the company, but the change in tax structure in the way we're seeing some of those profits, where we may not have been seeing them fully prior to 2017, or we may not be
Correct.
accounting for them, and now we are.
Correct.
Okay.
Correct.
Thank you.
I'd like to ask a question, then we'll get to Representative Ullery. So when did most of the repatriation occur? What year?
So for federal purposes, that would have occurred in 2017, the year 2017 and 2018, the year that the Tax Cut and Jobs Act went into effect. And then for New Hampshire purposes, we've seen that in tax years 18 and forward. But again, for New Hampshire purposes, it's only when the dividend is actually paid back.
So is it fair to say that effect is probably dropping off at this point?
That was kind of my point. Maybe not dropping off, but it's just kind of in our base at this point. There's no one-time revenue or significant change that we really need to account for. The impact of TCJA just kind of exists in our base revenue today, if that makes sense.
Yes.
Okay.
Okay, thank you. Representative Ullery and then Representative Almy.
Thank you. Just to follow up on Representative Platt's question regarding the rolling versus static. With the rolling, is it fair to say that under the adoption of a rolling adoption of federal law, we have suborned New Hampshire's, it's not subordinate. Yes. New Hampshire's tax code becomes subordinate to, subordinate is an entirely different meaning. I'm sorry about that. Federal law replaces
Right,
New
you
Hampshire
wouldn't-
law.
right.
We've surrendered our sovereignty regarding setting tax law.
Right. With rolling conformity, you are just going to conform to what the federal government has decided for the tax code for that year. And so having static conformity, you have the opportunity to make decisions and conform to specific versions of the code, decouple from specific versions of the code if you so choose. So yes.
Representative Almy.
Thank you. I just wanted to point out that, yes, the businesses will be have been getting more money, and that will continue, but we may not see it because from now on, we're based on the sales within New Hampshire. And we have no idea what that's going to do to us yet.
Correct. So how that is, Representative Almy is referring to the change in how we apportion or how we split out the pie of a business that operates in multiple states. And so we historically have looked at the payroll, the sales, and the property of a business to determine how large the piece of the pie is in New Hampshire. And going forward, we'll only be looking at the sales of that business compared to their sales everywhere else to determine the size of the piece of the pie.
Could I just have a follow-up?
Follow up?
well, this is actually going back to BPT, but on it, there must be some data on imports and exports from the state. Is there?
So we will have a better idea of the impact of moving to single sales factor once we've started to receive and have a significant number or a representative number of returns with market-based sourcing, because then we will have the new sourcing method for services and intangibles, and we can extrapolate from that what it would look like with just sales. So we are close, but we don't necessarily have it just yet. And if looking at import or export data, we would need to look at obviously both goods and services. And we'd need to know for services, how the apportionment works under market-based sourcing. So it's coming together, but we don't have all the data just yet.
Are we going to have that before the budget is finished?
No.
I didn't think so. Thank you.
Representative Ellery.
Thank you, Mr. Chair. You mentioned services. Following a couple of journals, a couple of beige, not quite white shoe law firms in Manchester now have offices in London and Paris, and I think one of them has one in Berlin too. But I'm not sure. That's a service they're offering. Regarding New Hampshire services, how would
So under cost of performance, we would look to where those services were provided. So if the lawyer was sitting here in New Hampshire and doing that work, then that work would be apportioned to New Hampshire. Now we're looking at market-based sourcing. So we look at where the customer is. So difference being, if you had an office in, to use your example, London and New Hampshire, under cost of performance, we would only be essentially taxing the services that were performed here in New Hampshire. Under market-based sourcing, we're going to tax all of the services that are performed for New Hampshire customers. So if I'm the New Hampshire customer and the attorney in London and the attorney in New Hampshire do work for me, then that is now going to get apportioned to New Hampshire. So rather where the service is performed, it's where the service is essentially received, where the customer is.
Follow up?
Not to use, yes, I will, use initials for a company who happens to operate in the United Kingdom and in New Hampshire. How's that going to, I don't know how you separate that out, how it's going to work. I really don't understand that.
It's the responsibility of the business to know where the customer is. And essentially the services, the value of the services performed for those customers in New Hampshire will be the services that'll be taxable here.
Okay. Looks like we are ready to move on to communication services tax.
Okay, moving on to slide 41, the CST communication services tax. Right now, so the CST is a 7% tax on two-way communication services only, and this tax is paid by the customer. So it's essentially a tax on the customer, but it's collected by the service providers. All two-way communication services providers are responsible for collecting and remitting the tax from the consumer and filing the return. The return is filed on a monthly basis and is filed on the 15th day of the following month. And if a liability under $100 per month, returns are filed quarterly and are due by the 15th day of the month following the quarter. And once again, there's estimates to be paid. Estimates are required if the tax liability is over $10,000 a month, and then it's collected by the 15th day of the month during which the liability is incurred. On slide 42, here you will see the CST revenue for a 10-year trend. It has been steadily declining since fiscal year 14, and then in fiscal year 21, you do see a sharper decline to fiscal year 22. And the potential reasons that we're seeing for this sharp decline is because of how companies, service providers are allocating the two-way communications, the services for that to voice versus for data. As for CST revenue, the services for data is not subject to for internet data is not subject to the CST tax.
Okay, page 43, Medicaid enhancement tax. So the Medicaid enhancement tax, you'll see, is a little bit unique. It's essentially collected by DRA, but it is spent by DHHS. So Medicaid enhancement tax is a 5.4% tax on net patient service revenue of hospitals. Taxes paid by general hospitals that provide inpatient and outpatient services, but not including government facilities. The tax period for MET is a 12-month period that begins on July 1 and ends on June 30, so it follows the state fiscal year. But the tax that's due is based on the hospital's fiscal year that ends within that taxable period. So it is not as straightforward as a regular business tax return, where you just operate under a normal, for most businesses, calendar year. The hospitals must file a non-binding estimate on or before January 15th of their estimated tax payment, and then they're required to make the payment and file their return no later than April 15th in the same year. For this year, for the taxable period that's is going to end June 30th, 2023, the non-binding estimates for the Medicaid enhancement tax were $302.1 million, and that is up from the prior taxable period actual amounts paid of $285 million.
We have a couple questions. Representative Ullery.
Yes, thank you. We're talking about Medicaid, therefore we're talking about federal dollars being sent back to the state, which the state is essentially skimming off. I'm using that phrase deliberately.
Intentionally.
Some of the monies that would be otherwise be going directly into patient services to give it to other patient services someplace else. The question is, who oversees where that other money is going? I mean, you collect it, but does anyone oversee it? Or is that strictly up to DHHS? And does not that skimming increase the cost billing made by the hospital or provider to the federal government through the state? To the federal government, so that the cost basis goes up, which means they get more money, which means everybody else has to pay more. I'm trying to figure that one out. If you can, if that's appropriate. Mr. Chair.
I'll answer your first question the same way for both questions. Department of Health and Human Services can better explain to you how the Medicaid enhancement tax revenue is matched federally and how it is spent via disproportionate share payments. So we're basically collecting the Medicaid enhancement tax and essentially turning it over in whole to DHHS in order for them to spend through the DISH program.
Thank you.
Representative Almy.
Thank you. I believe that most of the disproportionate share goes to the county nursing homes, doesn't it?
So
Or-
disproportionate share is going to go to it's going to go to the hospitals that pay the Met. We're going to talk about the nursing facility
Oh,
quality
right,
assessment
right,
in a
right, that's a
separate.
different one.
Yeah.
But yeah, this one is is our own hospitals.
Correct. So the hospitals that pay into Met will be the ones that will receive the disproportionate share payments. They do not necessarily receive the same amount in DISH as they paid in Met. That changed a number of years ago. So they receive, based on the formula in statute, a portion of the Met based on the calculation in statute, but it is not and no longer a one-for-one Met to DISH calculation.
Follow up?
Thank you. And that is required by the feds
Correct.
because we set up this scheme 20-something years ago on, I think it was Merrill, wasn't it? And it was essentially to get free money out of the feds to use as we wished, and we were using it in the hospital systems. But but we were just getting their share from them and giving it back to them in the same day. And we weren't supposed to talk about this in public at that point, but on that I was part of the group that had to create this contract with the hospitals, which took a lot of doing. But I think we haven't changed it much since that time, have we?
Correct. The majority of the changes were made starting in the 2014 time frame. And so we've been operating under the settlement agreement with the hospitals and the statutory construction since that time.
But my main question was on how different has the non-binding estimate been from the final
From the
Payment.
final,
over the years?
they're usually very accurate. Because of the delay essentially between the end of the hospital's fiscal year and the Met taxable period that it applies to, hospitals generally know the amount of Met that's going to be due. So their estimates are usually spot on. On page 44, we just again show a historical trend of Met. You can see it's, increasing pretty consistently year over year. You'll see that dip in fiscal year 21. That's an impact of COVID and the fact that a lot of elective procedures, non-emergency hospitalizations, et cetera, did not occur during that time. So that decreased the base for the Met. But you can see it, continued back on trend in fiscal year 22. As I've already kind of mentioned, DRA's role in the administration of Met, so they file the non-binding estimate with us on January 15th. We notify HHS of that amount. Then the returns and the payments are received by the 15th of April, and we deposit that money into the uncompensated care and Medicaid fund that's established under RSA 167:64. And the commissioner of HHS is responsible for expending those funds. We have the authority to audit and collect any outstanding Met revenues. So we have the audit and a collection ability, and HHS has the spending ability. On slide 46, this is the nursing facility quality assessment. It operates very similarly to the Met. It's just a tax on net patient revenues of nursing facilities. 5.5% tax. The assessments paid by the nursing facility as well as facilities licensed as a specialty hospital and certified to receive federal reimbursement as a nursing facility. This, rather than the Met having a year-long taxable period, the assessment period for NFQA is split into quarters. And so each facility files a return by the 10th of the month following the expiration of the quarter, and they pay and file their return at the same time. On slide 47, you can see, again, the 10-year trend with respect to the nursing facility quality assessment. And on slide 48, again, our role in the administration of NFQA. Again, we deposit the money directly into the nursing facility trust fund, and the commissioner of HHS is the one responsible for expending those funds.
All right, moving on to
I'm sorry, we have a question. Representative Allman?
Yes, the chart on page 47 only goes through 2020. And it was going up at that point, but we've got severe staffing shortages now, so.
That's a good point. We'll get you an updated chart. I'm not sure if it wasn't updated or if the labels are incorrect. I would note though, if you look at the amounts here, we're fluctuating between 37.3 million and 40.6. So it looks like a lot of fluctuation, but the scale I think is kind of what's causing that. But we'll make sure that we get you an updated version.
Okay, so the next tax item is utility property tax, UPT, RSA 83-F. This tax represents 0.01% of the 2.9 billion that's administered by the DRA. The tax rate is $6.60 per $1,000 of value of utility property, and the tax is on the value of the utility property, and so that's determined by the DRA on December 1st of each year. So this tax is paid on or before May 1st each year. The company shall file a form detailing the company's actual financial operating performance since April 1 of the prior year, and then the final payment is due on or before January 15th. And as with other taxes, the estimates are required. And
Sorry, I'm going to interject for just 1 second. One thing I want to just point out about UPT is it is a property tax. So you will see the reference to April 1st. So we are looking for the value of the property as of April 1st. It's a point in time. That's different than the other taxes that we've talked about, where we're talking about a taxable period. We're talking about the activity of a business over 12 months. So just noting, property taxes tend to look at just a singular point in time. So that's why you'll see the reference to April 1st. We're looking for the value as of April 1st.
Representative Ullery.
Thank you for my question, Mr. Keene. Looking at your chart, it looks like a sawtooth pattern is beginning to develop. And that looks like it starts right about the time we changed the assessment. Representative Abrami and this committee put together a bill to change the assessment of utilities properties at about the time this pattern starts to develop. The first question is this a sawtooth pattern going to continue up and down across the baseline of the plan 40 in your estimate, your guesstimate, I guess?
Right.
And
I'm sorry.
that's the first question. Go ahead.
Right. From our understanding of this sawtooth pattern is because of credits that's being available for the utility property companies when they have credits on account, so they won't be paying that much in terms of the taxes because they're using up that credit. So therefore, in the years where they have credits, the revenue will be down, and then the next year they make estimate payments that revenue would go up. So that's the indication of that. That's the sign of that sawtooth. Yeah.
Thank you. And one follow-up.
Follow-up?
The effect of this taxation, just for the record and for several of the members that are new, the effect of this taxation on the consumer rate, because the consumers are the ones that ultimately are paying this, is what? Do you have that information? Are you in coordination with the PUC on that? Because all the utilities, I believe, are regulated. There's no, except for in-house private utility companies, if I'm not correct.
We don't have specific information about how much the utility property tax versus a local property tax versus other taxes that the entity or the utilities might pay directly impact the consumer rates. You're correct that they do. It's an expense of the business. And so to the extent that they're regulated, it would be passed on to the consumer. But we don't have a breakdown for what UPT, like I said, versus the local property tax, et cetera, would have.
Okay.
Okay. Moving on to the next tax type is railroad tax, page 51. As Lindsay mentioned, for UPT, railroad tax is also a property type tax. and it's taxed on every railway express and every parlor, sleeping, or dining car company. And the tax is on the market value of the property's full and true value as of April 1. And there you see again the reference to April 1 for the property taxes. So the railroad property applies to both railroad companies and private rail cars operated for profit on any railroad in New Hampshire. So it's only on the rails that is in New Hampshire and not outside of New Hampshire. And when to file on or before May 1st of each year, the company shall file a form detailing the company's actual financial operating performance. And so similar to the UPT as well, you file a financial performance and then pay the taxes after that. So payment is due within 30 days from the date of notice of value of tax bill. And there's estimate payments as well.
Yes, Representative Ames.
Thank you. This question relates back to the utility property tax as well, and it's in both cases, railroad and utilities, DRA, as I understand it, determines the value of the property. And so my question is, over time, how has that value changed in terms of increased value, or has it stayed flat? You're getting a $6.60 rate on the value, so it sounds like the value has stayed flat. I don't know why it would. Is there litigation that's all related to on your determination of value brought by the utilities?
Sure. So yes, the DRA determines the value of the properties for both the utility property tax and the railroad tax. The property tax payers have the ability to appeal that value, and some do each year. And that process goes through a hearing. Well, first, there's potential negotiation for settlement. Then if the department and the taxpayer cannot reach an agreement, then that would go to hearing at the DRA and then could go on to the Board of Tax and Land Appeals, Superior Court, and Supreme Court if necessary. We haven't had any appeals go that far in recent years. The value that we set for the property is for, in the case of the utility property tax, for RSA 83F, but a number of municipalities use that same value for the local property value within their municipality, but not all. Some also value the property themselves through a private independent assessor. So it depends on the municipality whether they use our value or whether they determine their own local value. If they determine their own local value, then there could be litigation associated with that, but that would be outside of the work that we do.
Representative Ellery.
$500,000 for what? For operating a tourist attraction.
It's on the books and we administer it.
Thank you.
Okay,
All right.
on page 52, some more property taxes. So this is the statewide education property tax. The tax is assessed and collected by the municipalities to be retained for use by their local school district. The tax is assessed to everyone owning real property in the state, except those that pay the utility property tax or the railroad tax. And the department sets the rate at a level sufficient to generate revenue of $363 million. I would note that that amount was reduced to $263 million for fiscal year 23. There was a 1 year, $100 million reduction. The legislature decided to use surplus funds to essentially bridge that gap. And the rate is set to the nearest half cent necessary to generate the revenue required. Property taxes are based on local assessed valuations, and they're administered and collected by the individual cities and towns. Most property taxes are collected based on the market value of the property at its highest and best use, and there are various exemptions, credits, and deferrals, including elderly and blind exemptions, veterans tax credit, solar and wood heating and energy system credits as well.
Representative Elmy.
Thank you. I'd just like your opinion on, there's a lawsuit against the statewide property tax at this point. And the last time that there was one the legislature at least thought that it was tied to the county tax and the cooperative school district tax on property taxes, because they're all structured to be evaluated across multiple locally assessed valuations. Do you see any possibility that from that lawsuit that it affects our county taxes?
I am not aware of any reason why it would affect the county taxes. So when we set tax rates at DRA, to your point, we're looking at the total assessed value of the municipality, and then we're looking at the amount that needs to be raised for SWEPT. We're looking at the amount that needs to be raised for the county. We're looking at the amount that needs to be raised for the municipality and the local school district, and we're using that value to determine all of those. But it's just essentially a simple math exercise where we look at how much money needs to be raised for the county, and we divide it by the total taxable property, total assessed value, and that's how we figure out the rate. So they are, when you look at your tax bill, you know, if the tax rate in your town is $26 per thousand, that's going to be the total of all of the rates, but they're essentially calculated individually.
I believe well, I know that first lawsuit was based on the fact that the state had totally forgotten about its constitutional obligation to oversee the assessments every 5 years.
So we do monitor the assessments. We ensure that that every municipality does a full reevaluation every 5 years. Some municipalities decide to do it more frequently. We monitor to make sure that they are done at least every 5 years, and then we monitor compliance to make sure that those revaluations and reassessments are done in an acceptable way to the standards that that have been adopted under law. So we didn't forget anymore.
Representative Ames.
Well, just to clarify, and I know that you know this because you're actively involved in this litigation indirectly by providing affidavits and such. The issue now in SWEPT is unique to SWEPT because the issue is whether what is called excess SWEPT revenue can stay within the town that has collected that excess above adequacy, above the cost of adequacy. That's the issue.
Correct.
It's being hotly litigated as we speak, halfway through the briefing process, and in early March, I think briefing will be over and it'll be in the hands of the judge. So it's an important issue, and I'm saying this just because this is an opportunity to report back on an issue that also relates to one of my bills.
Yes, correct.
All right. On to the excavation tax.
Okay. Slides 54 and 55 are the excavation tax and the timber tax, also known as sticks and stones. These are taxes that are assessed by and paid to the local assessing officials. So this is municipal revenue, but the DRA is tasked with assisting the municipalities with administering these taxes. I won't go into detail about them. The rates are included here. Just know that we help the municipalities ensure that the proper amount of tax is collected and paid to the local municipalities.
All right, so the next slide, slide 55, is the timing of the DRA revenues. And just note that this data is based on the average of fiscal year 20 through 22 from the DAS revenue focus data. So this will be a very helpful tool table when you're trying to consider, okay, when are the times of the year that you'll see the majority of the income coming in, and just using the first table there on the left as an example, you'll see that the majority, the higher months where the incomes are coming in are in September, December, and then in March and April, and then in June. And those are the years of when the estimates are to be paid. And then in March and April, that's also the time of the months where the partnerships returns are due, as well as the corporate returns are due. And then you'll see moving on to M&R, usually it's more of a flat kind of a expectation in terms of when revenues are coming in, except for in August and September. And those are the higher months, probably when those are the times when activities for M&R are higher for the state. And tobacco, similarly, there's also a flat expectation for revenues on a monthly basis, because the tobacco tax is collected on a monthly basis, and similar with an M&R as well, it's all collected on a monthly basis. And then for I&D, you'll also see the similar peaks in September, in the months of where the estimates are coming in, September, and then December, and then in January, and then in April. As well as for RET, similarly, it's more driven by activity. And you'll see that the activities for RET transactions likely, because it's on the month after, so it's activities in July, but then collected in August, and then activities in August collected in September. And
Quick question, Representative Schamberg? Okay.
all right, and then the section below that is just a quarterly breakdown, which is easier to follow in terms of when you want to see each the monies coming in for each quarter, and then the sections under that is on a biannual.
I would just note, if I can, before your question, this is important when you're or we're working with you on doing revenue estimates, because we are going to estimate fiscal year 23 first to come up with a base, and then we're going to estimate growth rates for 24 and 25. We're going to use, when we do this, we're going to use data through January, so just over half of the year. I would point out I&D in particular. When you look at the data for the first half of the year of I&D, you've received just under 30% of the total revenue for the year. You still have almost 70% of the revenue still to come in. So this can be helpful when we're talking about revenue estimating, looking at the amount of revenue we've seen year to date. If we were to see something extreme with I&D, I would caution and tell you, well, we haven't seen most of the revenue yet. Most of that revenue is still to come. So this is really just to inform you about how we're going to estimate fiscal 23.
Thank you. Representative Schamberg.
Thank you, Mr. Chairman. Just a question on the business percentage of money on the quarterly, the tobacco percentage of money, and the RET percentage of money. Is there any particular reason why those come out to 101% versus the others that come out to 100?
Rounding.
Rounding.
You're pretty quick
Oh.
with your math.
What's that?
That was quick math.
Yes, it was. Just checking. All right. Thank you.
Representative Almy.
Fiscal years 20 to 22 have been rather unusual. Would there be a big difference if we went 10 years?
We could do that. Yeah.
Sorry, I'm not sure that on this year's going to be any less atypical. So
No, but
Next.
you bring up a good point, especially for business taxes, where during COVID there were some extended due dates that caused, at the federal level, that caused us to receive money a little bit out of whack, and that would be included in that fiscal 20 to 22. So we should probably look at a longer time frame.
That's a good point.
And the next slide, slide 56, the resources for where we compiled the data to provide to prepare this presentation. The annual report essentially is a very good tool. We publish the annual report annually. It's available on yes, right. It's available on our website for download, and it has a lot of data in terms of history, especially if any of the members here would want to know more about the history of each tax type. It is there in the annual report. And then the transparency page are documents that's available on our website. On the top right hand corner, there's a transparency link, and when you click on that, you have it bring you to the pie chart in terms of the total the breakdown of all the revenue types that's administered. And then further down, you can drill down further into the different tax types and the data that's available there. And then we also use data from the daily revenue updates, tax expenditure report, and the DRA listserv.
I'm assuming the annual report we can get, is it historical? Goes back a certain number of years? Okay. Great. Yeah. Any questions? So, okay, Representative Almy.
Yes, this says that
Microphone.
if we want to be added to the distribution list, we should let you know. I hope you're sending it to all of us, the dailies.
Yes, we are.
Thank you.
Representative Ames.
Now you're going to get it approved.
Yeah, the reference to the tax expenditure report reminds me of the legislative committee that reviews tax expenditures. I don't remember the exact name, but it has tax expenditures in it, which I think is a continuing committee, and we need to get it going again. I think that's just an opportunity to flag this, that there need to be appointments made to that committee. It's it changes every 2 years because legislators change, but I was on it last year, and so were several people, others from this committee.
Who makes the appointments?
The governor, probably the speaker and the Senate president.
Representative Almy?
Huh?
I'm calling Representative Almy.
Yeah, and I, about a month ago, sent an email to, what's her name, in the speaker's office. And I said I wanted to be on the dedicated fund committee again. And I explained to her who had been on the dedicated fund committee. And she took that and ran with it. So it needs some initiative from below, because they have all of these committees they have to appoint people to. So if we want something, in my case, we just needed people to be in place by June. But that's the same for yours, because I wrote both of them.
So I think that would be a good one for chair or vice chair to push forward. It's an important review process, sort of ensures we're looking at what we call tax expenditures, which are credits that are a way of moving money or keeping money in a place where policy says it will do good, and we want to make sure that that's happening that way.
Okay.
Rep.
Thank you.
Almy- oh, excuse me. Was that Jennifer Tramp, maybe? No. Okay.
Deborah Childs.
All right. Okay, we can continue.
Okay, so slide 57. We're going to give you a little preview about what we're going to do when we're back here on Thursday. So hopefully the goal is you have at least a very high level understanding of the various tax types so that we can help you start the revenue estimating process. As I've mentioned a couple times, we start with trying to estimate where fiscal year 23 is going to end up. And we do that by running a few scenarios. First, we say, what if revenue was just equal to plan? Then we say, what if we took actual revenue through January and that we were equal to plan for the rest of the year? Third scenario, what if we took actual revenue through January and revenue for the remaining months of the year equaled prior year? Then the last two scenarios we run, we say, what if revenue through January and then our percent difference from plan year to date remained for the rest of the year? So we're 5% above plan year to date. Let's assume we remain 5% above plan for the rest of the year. And then that same percentage change versus prior year. So if we are 10% ahead of prior year, year to date, let's assume we stay 10% ahead of prior year for the rest of the year. So we're going to run these 5 scenarios and we're going to look at them based on the knowledge that we have and kind of say, yeah, you know what, we've been 20% ahead of plan all year. There's no way that revenue is actually going to be equal to plan. We'll throw that one out. So we'll come back to you with what we think are the 2 most likely scenarios of what we're going to see in fiscal 23. Then we're going to give you a range of growth rates for 24 and 25. So you're going to take fiscal 23 revenue and then you're going to grow it for 24 and you're going to grow it again for 25. It may be negative growth depending on the tax type we're talking about, but I'll use the term growth. When we are doing the scenarios for fiscal 23 and then the growth rates for 24 and 25, we'll also work with you to take into account changes to existing tax law. So for instance, the I&D phase out. We have estimates of what that revenue impact will be, and we'll work those into the revenue estimates. So let's say we're going to grow, we'll use an extreme example. Let's say we're going to grow I&D by 50%. But we know that the impact of the rate reduction as I&D starts to phase out is 20 million. We'll grow it by 50% and then we'll take the 20 million out. What we won't worry about, and this is Chris and the LBA's job, what we're not going to worry about is any changes to legislation that this committee or any other committees or the Senate is currently considering. Those changes will happen in the surplus statement and the LBA will put that together. So we don't need to worry about any of the bills you've heard so far. All of that will happen in the surplus statement. We'll just worry about current law as it exists today.
Representative Plett has a question.
Thank you, Mr. Chair. Thank you for taking the question. You rank order what you present in terms of least revenue impact or most revenue impact, tax by tax.
We tend to just give you what we feel is the most reasonable range.
I understand that, but having done that, one tax is going to produce 3 million, one's going to produce 30 million, one's going to produce 50 million, and so on. Can rank order them?
You want us to do them highest? I'm sorry, I'm not understanding the question.
I'm asking again for the least tax impact volume for one tax to bigger, or the other way around. So we could perhaps take the bottom layer of revenues and just accept, and then go dig into.
I see what you're saying.
Yeah.
Sure. So what we'll do when we come in on Thursday is we'll kind of present all of the revenues to you so that you can understand what we're talking about. And then with Chris, and the chair and vice chair, I think you'll work on determining what revenues you want to tackle first. And to your point, there may be some that you know the revenue estimate right away, so you can just get those out of the way and then save the more difficult work for later. So I think there's flexibility in the order in which you take the taxes.
Yes, that's correct. We can take them up in whatever order we want. And typically, we will start with the ones that aren't varying too much and make those estimates and then go to the more difficult ones as we get more information. Representative Ullery.
Thank you, Mr. Chair. Tennessee recently went through an I&D reduction. I think that's the most recent state. Can we get something from them to show what happened there? So we have just a general idea. I think their I&D was a lot bigger hit than ours will be. And I'm just trying to balance.
Yeah, we can look and see if there's anything that we can glean from that. To your point, their IND, it was a larger tax base, much larger revenue. And when we're looking at the fiscal impact of the IND repeal, it's pretty formulaic, just in terms of it was taxed at 5%. We know what the base is. And then we kind of just recalculate for each of the various rates. But we'll look and see if there's anything that we can kind of glean from what happened in Tennessee.
Follow up?
Yes, yeah, well, there's two things. One, you said you know what the tax base is, except it's changed because of a couple of factors which we've already discussed, but that's neither here nor there. We're not on topic exactly. In talking with some representatives from Tennessee, they were hesitant, very concerned about going forward with their IND, and then pleasantly surprised. Could you talk to your colleagues and determine why they were pleasantly surprised?
Sure. We'll see what we can find out.
Yeah, I would. It'd be kind of interesting. So it gives us a place to start. Somebody else has gone through this already, and let the volunteers figure it out.
Figure it out. Sure. Any other questions on the revenue kind of estimating process? And we'll be here along with Chris throughout all of it with you. So, okay. Slide 58, I just wanted to take a couple of minutes to, I guess, both update and inform the committee. I know there are some representatives who've been on the committee for a while, but I know a number of you are new. So I just wanted to kind of get everybody up to speed on what the DRA refers to as our Revenue Information Management System, or RIMS. So the DRA received a $30,160,000 capital appropriation to replace our aging tax information system known as TIMS. We do taxes. We're not the most creative people, so cut us a break on the naming. We replaced TIMS with RIMS. TIMS was implemented in 1990. It was obsolete. It was very limited in its functionality. It was a COBOL-based system, so black background, green flashing cursor, no ability to use a mouse. Everything was function keys.
And what's wrong with that?
It's tried and true technology, but things have come a long way in the past 30 years.
Punch machines.
So RIMS is used internally at DRA and is also used by taxpayers and practitioners. We implemented it in conjunction with DOIT, and again, it's a complete overhaul of our back-end technology system, and it really consolidated many disparate systems into one. Fast Enterprises was selected through an RFP process to provide their commercial off-the-shelf or COTS software known as Gentax. Fast and Gentax operate in many, many, many states. This is what they do. They do tax administration and they do it well, so we feel lucky to have partnered with them. The implementation of RIMS consisted of 3 phases. Each took about a year, and the contract also includes support and maintenance. The total cost for that contract was $29,550,000. On slide 59, you can see the various rollouts. We had 3 rollouts, as I mentioned. We started with the meals and rentals tax, Medicaid enhancement tax, and NFQA. We moved into our larger tax types of business taxes, interest and dividends, and communication services tax. And then in the 3rd and final rollout, we implemented tobacco, RET, UPT, etc. I will note all of these rollouts were on time and on budget. You will see they go right through the COVID-19 pandemic. We pivoted at the time. We worked from home. We did everything that was necessary, and we remained on time and our budget. So I'm very proud of that work. Our employees and our vendor worked very hard, and it really propelled DRA forward.
We have a question from Representative Yullery.
Thank you.
Surprise. Thank you for the operation of this. I was, as you know, part of this entire thing.
Yeah.
At least on the edge.
Yeah.
The On the rim. Yeah.
There you go.
I saw you smile. The question I'm asking is, and we asked this when back in 2017, 2018, this was intended to make DRA more efficient.
Mhm.
It was intended to reduce some of the manpower because you were replacing that with machine power. It was also intended to be more consumer friendly. I take from this presentation and from your general attitude regarding this and the degree of the material we found, some of those goals have been met. Have they been met? I'm trying to justify the expenditure of the $30 million to people that perhaps don't necessarily want the government to spend money on government.
Sure. So I would say an overwhelming yes to all of your questions. RIMS delivered what we thought it could and should deliver. In terms of efficiency, we are able to process all of our returns, deal with all taxpayer interactions, requests for refunds, et cetera, in a very timely manner. We did not see significant delays in the work that we produce as a result of the hiring shortages that all businesses and government has felt over the past few years. We have been operating at about 15% vacancy rate for close to a year and a half, 2 years now, and everything is still happening on time. So people should not be experiencing any delays as a result of the staffing shortage, and that is due to the fact that RIMS is more efficient. We've been able to reallocate resources to work that used to have long backlogs because RIMS is more efficient. So, for instance, processing a maintenance request from a taxpayer. We had to process returns into the system. That was the first priority. And then we could work on maintenance for the taxpayer. Now the returns get processed so much easier through the system that employees that used to do that can now work on taxpayer maintenance. So we have seen kind of all of those benefits that we hope to see internally at DRA. In terms of for the taxpayers and practitioners, on slide 60, this is just an example. It's a copy of the front page of Granite Tax Connect. So Granite Tax Connect is our online web portal. So it allows taxpayers and practitioners to access their account, to see the payment that you made, that the check was actually cashed, to look at your current account status. None of that functionality existed before RIMS. If you had a question about your account, you would call into our call center and they would answer your question in a very polite and timely way, but you couldn't do it at 12 o'clock at night. You'd have to wait for our business hours. You couldn't do it on the weekend, etc. So this is a picture of GTC. I will call out for you a few things that even without a Granite Tax Connect account, you can apply for a meals and rentals tax license. You can make a payment. We will take your money. You can request a payment plan. You can upload a power of attorney form. If you have a new power of attorney, you can send that to us right through GTC without having to create an account. So these are just a few things that you can do, like I said, even without utilizing a full GTC account. Another benefit, if you are a taxpayer and you're using GTC and you're stuck, you're trying to file a return, let's say, and you're stuck, you can't figure out, what button you're supposed to hit next or what information goes where. If you call into our call center, you can provide them with a session ID number that shows on your screen, and they can watch what you're doing. So they can provide you real-time assistance. So you don't have to worry about spinning your wheels and not being able to effectuate what you need to in the system. Our call center is wonderful. We have 5 people dedicated full-time to our call center. Additional employees fill in as needed. There's a survey at the end of the call. If anyone's ever called in, you get a survey. You can rate us from 1 to 5 on our professionalism and 1 to 5 on our knowledge. We routinely receive very high marks. You also have the ability to leave a message, and that's kind of my favorite part. I get a summary of all the messages at the end of each week. And people routinely praise us for just answering the phone. Apparently that's a novel idea these days. But just how helpful our employees are. And a lot of that is because of RIMS and the ability for both taxpayers, practitioners, and the DRA to be seeing the same data at the same time. There's one last piece of the RIMS benefit that I think you also might be interested in, which is on slide 61. So part of the reason, or part of the way that the legislature funded RIMS was the $30,160,000 appropriation. But the interest, the principal and interest on those bonds, $6 million is paid for by the general fund, but the remaining $24,160,000 of principal and interest is actually funded by revenue uplift that's resulted from the system. So we anticipated that there would be a benefit to the system. And so we have, under statute, are required to transfer money into a dedicated fund to pay the principal and interest. And we're going to do that until the fund reaches $40 million, which is what we anticipate the total principal and interest to be on that $24,160,000. And on slide 62, you can see what we've done with that to date. So we're going to transfer $40 million in total, but we cannot transfer more than $4 million in each year. So in fiscal 2020, that was the first year that RIMS was operational. We did not transfer any money. The system was just up and running. We hadn't received any additional uplift. In fiscal year 22, or 21, excuse me, we transferred $2.2 million. And then in fiscal 22, we transferred the full $4 million. You will see in the chart at the bottom, the total revenue uplift we realized in fiscal 22 was actually $5.3 million, but we were capped at that $4 million amount. So that's why it was only $4 million and not the 5.3. We've done this, we've achieved this revenue uplift in a couple of ways. One is the system allows us to automatically send a reminder to pay letter. So before RIMS, we would issue a tax notice and we would not contact you again until you didn't pay that notice and you ended up in collections. Now, after 30 days, we send you a nice note that just reminds you that we had sent you a bill and that you need to pay it. And so just that reminder has generated a good portion of this amount. We also now have more efficient use of data that we receive from the federal government in order to ensure compliance with New Hampshire laws. So we can look at federal data. We can see that a business may have a filing obligation. We can see that they have not met their filing obligation in New Hampshire, and we can proactively reach out to that business. So better use of federal tax information has also contributed to that.
I have a question, then we'll go to others. I believe I have a login to this system, and I guess my question is, if you have multiple, can you have multiple entities on the same login?
You can. So if you were a restaurant, for instance, you could have your meals and rentals tax license and also your business tax license would show under the same login. If you operate multiple businesses, you can have multiple businesses show under your login. If you are a tax preparer, you can log into your account, and so long as your clients have granted you access, you can see the various accounts of your different clients. And what you can do under those accounts might differ for each client, right? I might say, sure, representative, you can look at my account, but I don't want you filing anything on my behalf. Keen may say, you can file all my returns for me. So taxpayers can set those individual parameters for their practitioners.
Okay, great. Thank you. We'll start on this side of the room this time. Representative Orris.
Thank you, Mr. Chair. Thanks for that report. It's very interesting that you were able to do that through the COVID. Having worked with the Department of Defense in London, Scotland, and here, and a couple of agencies auditing and as a program manager, it's impressive that you did it on time, on budget. I hope you got an award, you and your team. Thank you.
Thank you.
Yes, Representative Bolton.
Regarding the need to go from COBOL, which is not supported, to at least a platform that is supported. Now, is it being maintained offsite, or is Do It maintaining it
So-
currently?
That's a great question. So it's I guess a little bit of a hybrid. So the actual physical hardware is located here in New Hampshire at Hazen Drive, and the maintenance of the system is done in conjunction with DRA employees, DOIT employees, and we do still have vendor employees on site. So at the height of implementation, we were probably at 30 to 35 vendor employees, and we're down to about 8 to 10. I anticipate, and we're asking for in our operating budget, to maintain a level of the vendor employees for a couple more years as we make sure that we can continue to maintain this system, because it is such a big change going from the COBOL system to this more modern system.
Follow up.
Follow up?
So regarding the maintenance at Do It on Hazen Drive, they have normal business hours, and you want us to support it outside of business hours.
Correct. So we have an agreement with the vendor for 24/7 monitoring. So we do have the ability to make sure that the system is up and running at all times. So they have remote monitoring for the times that we're not our non-business hours.
Thank you.
Okay, Representative Almy. Oh, I'm sorry. Oh, I'm sorry, Representative Malloy.
I was blocking him on purpose.
Thank you, Mr. Chairman. Thank you for taking my question. Commissioner Stepp, I think, yes, you are to be commended for this implementation. I was here in the year when we looked at that 30 million and said, let's go.
Yeah.
So and your report out today was really nice to hear all that. I have a question about that 29 million fee. Maybe it was buried in all those numbers that you put through there.
Sure.
But that 29 million is coming from where? How does that factor into the where does that come from?
Sure. So the 29,550,000 is from the $30,160,000 capital appropriation. And that was funding for the 3-year implementation of RIMS, basic hardware and software maintenance for 7 years, and some additional post-implementation support. We will be requesting in our operating budget to kind of maintain that additional post-implementation support. The difference between the 29,550 and the 30,160 is we had a vendor, Barry Dunn, perform independent health assessments of the project as we went through it. So they would come in a couple times a year. They would look at documentation about the status of the project. They would interview DOIT staff, DRA staff, and vendor staff to make sure that the project was healthy. I felt nervous about being in charge of $30 million for one project and wanted to make sure that the project was moving along smoothly. Because on any given day, the project manager of the vendor could have been like, yeah, everything's fine. And I worried we would get to the end of the project and we would be missing things or things wouldn't be the way that they should be. So we contracted with Barry Dunn to do these periodic health assessments. I can provide anyone that would like a copy of them. They were all glowing, and they reassured us that we were on the right track in terms of making sure that this project was going to be successful.
Does that same vendor provide security, or is there another vendor that provides security for the system?
So security is provided through Fast Enterprises. However, we have contracted recently with New Harbor through DOIT to do a security assessment and to do penetration testing, and we will keep up those assessments with the assistance of vendors and DOIT going forward. So we make sure that the system is functional but also secure.
Thank you. Representative Almy.
Turn it on. Thanks. The money is coming from increases in meals and rooms, interest and dividends, probably some of the others as well. Does it get removed from the amount that shows up at some point on each year?
Good question. So the amounts are transferred once the fiscal year has closed and would be accounted for in the ACFR. So if you're looking at cash basis numbers, which is what we typically look at, the cash basis numbers will include this $4 million. They're essentially removed in the accounting adjustments that happen between the close of the year and the ACFR.
So they show up in the CAFR.
Correct.
Thanks.
Representative Schoenberg.
Thank you, Mr. Chairman. A great overview of the process. I noticed on page 40, an example, you listed factors, influence, and revenue. You did that on a bunch of the pages. The DRA uses historical trends and does static analysis. Do you see any probability of the DRA using an organization to do future probability analysis to help you maybe see what a trend is going to be in the future?
Sure. I think that's a great question. As you mentioned, we have typically in the past done a static analysis. So we have looked at, if this change were to have happened last year, how would last year's revenues be impacted by that change? We have not, when we do that sort of analysis, we don't take into account, would that change influence behavior and therefore then cause revenues of maybe another tax type to increase or decrease, or revenues within that tax type to increase or decrease? I think the hardest thing about doing a more dynamic analysis is, one, manpower. We are a small agency and a small group that does this work. So certainly with additional staffing, that's something that we might be able to consider, or with additional funding, we could contract out to a consultant or a third party that does that sort of work. The other thing that I would note is that typically that sort of work, a more dynamic analysis, is usually fairly time consuming, and we're operating under pretty strict time constraints within a legislative session. This is no fault of Chris's, but when the LBA sends us a fiscal note to complete, they ask for it back within 5 days because they're trying to get it on the bill and get the bill published so you all can have that information. 5 days is probably not enough time for us to do a more sophisticated dynamic analysis. That being said, though, there may be opportunities where a tax policy choice or a tax policy consideration or option that could be evaluated over a longer period of time and not the 5-day turnaround for a fiscal note could benefit from that sort of analysis. Something that comes to mind is, the School Funding Commission that operated a few years ago. That commission had an appropriation to spend money on a consultant to have those resources to provide that. So long story short, it's a resource, whether it's people, money, or time constraint.
Representative Ellery.
Two things, and I'll keep the first one to this issue, and the second one deals with the member. How could you find out how much Watson costs per hour? Just let us know.
I mean, I can put a line in my operating budget for Watson, a crystal ball, a magic 8-ball.
I look for crystal balls. They're too
There's-
damned expensive.
Okay.
And then just for the committee,
Sure.
I think Representative Uri wanted to tell us all of the.
Put your microphone on, please.
So the news is that Gary Hopper, Honorable Gary Hopper, has died.
I'm sorry to hear that.
Thank you.
Representative Almy.
Thank you. I had one small question and something else about the dynamic analysis options. The small question is, are people who file by paper still allowed to do it?
They are still allowed to do it. We do not have a prohibition against paper filing. Some states do. We are not one of those. We have, as part of the front end of our RIMS system, we have 2 high-speed scanners that process those paper returns. So if you fill out a return online and print it and mail it to us, there's a 2D barcode that's generated as part of that return, and our scanners pick up the information that you entered through that 2D barcode. If you handwrite your return, many people do, our scanners are able to read handwriting, and they will they will attempt to read handwriting, I will say. And for anything that the scanner has trouble reading, it will prompt a human. Our data entry folks will be prompted to review what the return says and enter the amounts. We did receive some ARPA funds to upgrade our scanner. Because one of our scanners is at the end of life. So we will be disposing of that scanner. We will be purchasing a brand new scanner, and we will be rehabbing our existing scanners so that we can still have 2 running at the same time. My biggest fear is that our scanners go down on April 16th. So we always want to make sure that we have 2 of them going at any time. We also obviously receive electronic returns. So similar to you filing your federal tax return via the IRS's modified e-file program, you would file, your return essentially goes to the IRS carves off the New Hampshire piece and sends it to us. So we also receive many returns electronically, but we're always happy to have paper as well.
Thank you. And could I,
Follow up?
this is not a follow-up, this is
Okay.
about the dynamic analysis. I was going to put in a bill this year, and I had a health emergency, and I had prepared it 2 months ahead of time, and I forgot about it during that brief window we had, on which looks at something like, but I think that the only place that does it is REMI. On REMI, on regional economic, macroeconomic, and I never can remember what the I stands for, but they have been working for 40 years now. The gentleman that started it built an original model to look at on trying to predict the future for things like this. And they work only, and there are, I think, 28 of them in total. In the country, they are based in DC, but they have an office in Amherst, Massachusetts. And they work with states and municipalities only, and counties. They will not work with non-governmental institutions. And we actually, a couple of us, Representative Schamberg and I, and Jerry Stringham, who we'd hope to have back in the committee, he's in finance, and talked with them this summer. And we wanted, as a next step, to be bringing in Representative Abrami to this conversation. That didn't work out either. But when we talked to them, we discovered that we already have a REMI group in New Hampshire. It consists of Gottlob, Brian Gottlob, and he went to the employment security group because they would let him do this. He's been working in multivariate analysis all of his life, and this is kind of the gold star of it as far as I've been able to determine. But I went in skeptical. I don't know whether
you have
you
a
did too.
Representative Almond, do you
but
have a
we were
question for?
impressed.
for
It's
DRA?
not really a question, it's just information, as this is an alternative that we could put somewhere. And you were talking about things that we can't, it can't be contracted out. It has to be something with one person somewhere in the institution. And the bill I put in was to try to set up a commission to decide where and how and if, of course. But
Okay, thank you. Any questions on the presentation as a whole? Any of the taxes that we've gone over? Any questions? Okay, seeing none, thank you very much.
you. We'll
Great
see.
presentation, very informative.
Thank you. We'll see you on Thursday.
Excellent, thank you. All right, so tomorrow we have Chris. Oh. Sure, sure. I guess going back to Representative Plett's suggestion of, hitting these in order of size. I mean, we don't necessarily do that, correct? It's more like we start with the ones that are more predictable. And so if you can just tell us.
Correct. I think take SWEP, for example. It's a $363 million revenue stream set by statute. You're going to get that same amount. So this committee can easily make a decision that they want to stick with that number unless you're going to introduce something new related to that. I think what you've seen this committee do is tackle what we would consider those easier revenue sources, such as a lot of what the agencies that have already come into you. So maybe insurance, maybe the securities, maybe the HHS amounts. So you might look at some of these and say, okay, as a group, we don't feel we can have anything to add or change to those revenue estimates that they provided, so we can feel comfortable with those numbers. The ones that you tend to focus on and spend a little bit more time with would be the things like your business taxes, your RET, your IND, your meals and rooms. Those seem to be the taxes where there's a little bit more flexibility, a little bit more thought put into, because there's a lot more influencing how those taxes come in. What our job is, or my job is to provide you with a worksheet and help guide you through the process, but you direct that process overall. So you decide when you're ready to say, this is the tax we want to work on today. So as a segue, Thursday, you're going to be meeting. You're going to start with DRA. So the commissioner and her team will come back and they'll give you some of their estimates related to the revenue streams that you need to do projections for. They'll take as much time on Thursday as they need to with you. And when they're done, I'll come up to the table and say, okay, here's these other revenue taxes, these other revenues that if you're comfortable, you can start making some decisions. But if you're not and you think you need an agency to come back, let me know so that I can get them scheduled to come back for you. So that will be the second part of Thursday. Again, I don't know how long all this will take, and you need to be comfortable with the information you're getting. If between now and Thursday, if people have questions, please shoot them my way. The email, call me, particularly if it's related to the DRA stuff, so that I can let the commissioner know so they can come prepared to respond to that. Also, you've got scheduled dates in February 27th and 28th and March 1st to come back and finalize, I think, your estimates. Right now, you have the governor's budget director coming in on the 27th. He was originally scheduled to come in on the 22nd, but that date has been canceled due to potential session day. So he'll be available to answer any questions you might have as it relates to the governor's revenue estimates. On that Tuesday, February 28th, you have Employment Security coming back with an update. The committee had requested last week if we could have them come back to provide some information to you as in terms of workforce issues they might be seeing in terms of good or bad trends. So that's going to be their focus. But they also understand there may be other employment related questions that may come to them. So that's who I have for you in the next 2 weeks.
Excellent. We have some questions. Representative Fellows.
Thank you. Can you tell me what the governor's estimates are going to look like? Is it going to be a spreadsheet, and do we get it before his director comes and speaks to us so we can look at it and think about questions?
So tomorrow, when the governor comes and presents to the legislature, you'll have an executive summary that will be presented. So it'll be a printed document. In there would be the revenues, and they would be listed similar to you see the unrestricted revenues listed now. So you'd see his projections for 23, 24, and 25. So it wouldn't be in a spreadsheet per se. It'll be in a table format.
But Chris, you'll end up putting them into a spreadsheet for us.
Yes. So the worksheet that we keep talking about that many of you probably haven't seen will have the governor's information included on that. So it should be a one-stop shop for you. So you'd have a document in front of you that you'll be able to see 22's planned revenues, what the ACFR's 22 revenues were, 23 plan, then the governor's estimates, agency estimates, and then your estimates. And that would be the same for 24 and 25.
Okay. Follow up?
And so when we get it in that format, the one that you've put together, we'll have more back history, a couple more columns going back so we can look at pre-COVID.
Not necessarily, no. It just shows you 22, 23, 24, 25. The back history would be in some of the information you've been gathering to this point. The ACFR has the 10-year plan, or excuse me, the 10-year showing of revenues, so you can get a sense of how revenues might have trended. But if there's something specific, I think last week you had asked about the tobacco settlement money, and there was a request to have a 10-year look at that, and I've sent something out to the committee related to that to basically show the projections that were made by the DOJ and then where the actual settlement amounts came in.
Representative Ullery.
Yeah, thank you. Just so the committee is clear, we're not looking at the budget. We're only looking at the governor's estimates and our estimates. The budget itself will be up at the top of the hall and finance, and they get what 1,200 pages or so of stuff. There's another word for that, but
Okay. Representative Almy.
Thank you. Two things. We used to get much more information from insurance about the context of their numbers than we've gotten this time. They would talk to us about hard markets and soft markets and on the property and casualty versus the health and et cetera. And I didn't see any of that in what we got. I just saw some numbers.
I think you're absolutely correct. If the committee would like them to come back and go deeper into how they get to their revenue estimates, that would be an agency we could ask to come
Yeah.
back on the 27th or
that
28th.
Whether the market is hard or soft in various categories does change what their numbers are.
I think the commissioner touched upon that briefly during the presentation, but it wasn't written in the presentation. But again, I take direction from the committee. If the committee's decision is to have them come back, then I will do that. So I would defer to the chair and vice chair to let me know who they need to have come back.
Do you remember how much variability we typically see in the insurance numbers?
Not
We can-
from what they plan to what you actually collect.
Well, from year to year, do we see much variability?
I would say no. I mean, I think compared to what they present to you and what they actually collect are fairly similar numbers. There may be some slight adjustments up, and I think you're seeing that right now. I sent out to the committee a revised estimate for 23 for insurance. It also had lottery commissions information on it. I sent that out on Friday. So you'll see that they bumped their number up from 135 million for 23 up to 139 million, but it didn't have any impact on the 24-25 estimates. Again, it's partly because of the way they collect that revenue stream.
Right. Thank you. Representative Rochford.
Yes, thank you. So we've heard a lot of taxes, and one of the taxes that I've seen just in passing, and we haven't expounded on it because I don't, maybe it's dedicated, is the beer tax.
Yeah, that was in with Liquor's presentation. It was one line. No, that's fine because it doesn't really get talked about. It's about 13.1 to 2 million a year. It doesn't change really. There's not much fluctuation to that. What the Liquor Commission has testified to in the past is that what you've seen is a shifting towards some of the more microbrew type beers and away from your more traditional beers, but the overall revenue has not changed as it relates to that. And that revenue is based on the gallons sold. There's a 30-cent tax. Yep. They all need to be distributed through central points within New Hampshire. There's certain distributors that manage that and collect that tax for the Liquor Commission.
All right. Any Representative Almy?
Thank you. My other request was that we get the 10-year on compendium of taxes that's in CAFR with the ETF and the GF combined so that we don't have to keep on adding them up. That it comes.
I can put that together for the committee if it's something that would be helpful. Yes.
I've spent a lot of time over the years adding those things up.
All right. Anything else? Thank you, Chris.
You're welcome.
So that pretty much concludes our activities today. So let's see, going forward tomorrow, you all know we have a house session. Wednesday, we'll be back here. 10 o'clock, we'll be in exec session first on HB 288, 297, and 569. And then from 10:30, roughly from 10:30 on, we'll have, I didn't write those down, we have public hearings on several bills. Wednesday's the exec session at the beginning, then followed by public hearings.
It's 220, 510, 568, and 607.
Okay. No, 569 is an exec.
Yeah.
Yeah. And then, of course, Thursday, then we'll be back here on Thursday, the 16th, 10 o'clock for revenue estimates. So we'll start that process. Any questions?
No, this should be the busiest week until we get closer to crossover. Just put it in perspective.
This will be a busy week, yes.
The rest of the week should just be 2 or 3, like that.
Well,
Yeah, well, yeah, in general, we shouldn't have four days up here. That's, yes.
So our Wednesday, we're meeting at 10 a.m.?
Wednesday, yes, 10 a.m.
Okay. And is there a caucus before the session on Tuesday? Yes? 9? Okay. Thank you.
And breakfast across the street.
Oh, before the session tomorrow, you're saying? Yes, tomorrow. All right. Thank you, everyone. I figured it would end around 12.
Yeah.
12 o'clock.
Did a good job.
Thank you. Yeah. What do you mean more? Talking about the here?
hearings.
I would think so. Why?
Because she has a major conflict of interest.